Welcome to S&P's European Loan Market Video Overview, detailing leveraged finance trends and activity during January 2012. I'm Suchit Gupta, a member of S&P Capital IQ's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in February and early March 2012. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the more than 7,000 contacts in LCD's Leveraged Loan Group on LinkedIn. The links to follow LCD are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. After the holiday break, the market reopened, but probably not to the extent that arrangers had hoped for. The secondary loan market finished the month up 168 bips at 95.14, the highest read since August 2011. While high-yield bonds finished the month up 544 bips at 93.9, the highest read since October 2011. Loan issuance stood at 1.2 billion euros for the month, while high-yield bond issuance stood at 1.5 billion euros for the month. The S&P European Leveraged Loan Index, the LE, had a positive return of 2.19% ex-currency for the month of January. The secondary markets are up, not surprising given the lack of primary issuance. The primary markets have opened up, but not to the extent that arrangers and even some investors would have hoped for. Default rates have stayed steady, but most investors expect them to tick up further this year. Focusing on the secondary loan market, this chart details the average price of LCD's European Loan Flow Name Composite, a measure of the 14 largest, most liquid loans, consisting of 10 issuers since 2002. Loan investors who've been facing a dearth of new issues in the primary market turned their attention to the secondary markets, hence the uptick in secondary loan prices. The flow names rose 168 bips to close the month at 95.14, the highest read since August 2011. This next chart details the average price of LCD's European High-Yield Flow Name Composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market gained 544 bips during the month to close the month at 93.9, the highest read since October 2011. This chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. Given the positive performance of loans in the secondary, it's not surprising that the European loan market posted a positive return of 2.19% for January, up from the positive 0.38% seen in December 2011. The total LE return for January 2011, i.e. last year, was a positive 2.45%. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. The primary market reopened in January, but not to the extent that arrangers would have liked. New issue leveraged loan volume for January 2012 was 1.2 billion euros, while the high-yield bond issuance was 1.5 billion euros. The real story, however, was a number of European issuers who accessed the U.S. markets for both loans and high yield. This next chart shows how prolific European issuers have been in accessing the U.S. dollar markets. In just January 2012, the U.S. markets provided a record high of 9.7 billion of leveraged finance volume to European borrowers, up from just 2.6 billion euros in the fourth quarter 2011. January's tally, including transactions that had launched but not yet priced by the end of the month, is also more than half of the 2011 full figure of 15.7 billion euros. Given the continued volatile and difficult macroeconomic concerns, most people expect default rates to tick higher during the year. The default rate by principal amount still stands at 4.09 at the end of January 2012. Meanwhile, the default rate by issuer count is up to 3.8% at the end of January, up from 3.4% at the end of December 2011. In summary, European borrowers will continue to tap the US dollar market going forward for both loans and bonds. And for those European high-yield bond issuers who have lower ratings, this access to liquidity might justify the higher cost. Banks are still wary to underwrite new transactions. You're also seeing a larger MLA and bookrunner groups as banks try to spread the risk around, underwriting risk around, as well as try to determine what the roles would be. Given the volatile and bleak macroeconomic conditions, most market participants expect default rates to rise in 2012. According to the latest LCD default survey of loan managers, default rates are expected to rise to 5.9% by the end of 2012 for default rates by principal amount. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including U.S. loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.